how the wealthy protect their money while everyone else loses. The first thing to understand is that the wealthy do not simply get lucky. They have systems, they have strategies, they have a playbook that most people never learn because the financial world is designed to reward those who already have access. While inflation quietly eats away at the value of everyday savings, the wealthy shift their money into assets that grow faster than prices. They treat money like a tool, not a static thing to hold. That is the key difference. Most people think saving is the path to security. The wealthy know that saving is only safe if the value of money stays stable, and the truth is, it rarely does. That is why diversification is one of the first things they do. Diversifying is not just a buzzword, it is a protective strategy that spreads risk across different asset classes. When one asset class drops, another may rise, and the overall portfolio remains balanced. The wealthy also understand that the financial system is not built to protect cash. Cash loses value over time due to inflation, and that loss is disguised because it happens slowly. So instead of holding everything in cash, they hold a mix of assets that include investments that can grow, assets that provide stability, and cash that is strategically held for opportunities. Another difference is access. The wealthy often have access to investment opportunities that ordinary people do not. They can invest in private markets, exclusive funds, or specialized assets. That gives them an edge. But even beyond access, the mindset is different. They treat money as a system that needs maintenance. This is not about being greedy or secretive. It is about understanding the rules of the financial game. The wealthy play by the rules, but they play with strategies that are not commonly taught. The result is that they can protect their wealth while the average person sees their savings slowly lose value. Diversify across asset classes. Diversification is one of the most powerful tools the wealthy use, and it is often misunderstood. Diversification is not just about spreading money across a few stocks. It is about holding different types of assets that behave differently in different conditions. The wealthy understand that markets are unpredictable, and they build portfolios that can withstand change. That means a mix of stocks, bonds, real estate, commodities, and sometimes alternative investments like private equity. The point is not to chase the highest returns in one area. It is to build a system that can survive the worst-case scenario. When inflation rises, some assets perform well. When interest rates rise, other assets perform better. When markets crash, certain assets hold value. This strategy is especially important during inflationary periods. Inflation affects different assets in different ways. Some assets rise in value, some lose value, and some stay stable. The wealthy use diversification to ensure that they are not entirely exposed to one type of risk. The average person often invests based on emotions or trends, but the wealthy invest based on structure and protection. They know that the market is cyclical, and they prepare for the cycles. Diversification is not a guarantee, but it is a foundation. It is the difference between surviving and thriving, and it is one of the main reasons why the wealthy can protect their money while others struggle. Hold cash reserves strategically. The wealthy do not avoid cash. They simply treat cash differently. Cash is not a long-term investment, it is a tool. The wealthy hold cash reserves strategically, not because they expect it to grow, but because they know it gives them flexibility. Cash is power because it allows them to move quickly when opportunities arise. This is one of the biggest differences between the wealthy and everyone else. Most people hold cash because they are afraid to invest. The wealthy hold cash because they are prepared to invest. They use cash as a weapon, not a shelter. It gives them the ability to act when others are frozen by fear. Cash reserves also provide stability. When markets are volatile, having cash reduces the need to sell assets at a loss. It allows the wealthy to maintain their positions and wait for the market to recover. It is a way to stay calm during chaos. The key is that cash is used intentionally. The wealthy do not let cash sit idle. They use it as a tactical resource. The truth is that cash is not the enemy. It is simply a tool that needs to be used wisely, and the wealthy understand that more than most people do. Invest in tax-advantaged accounts. Taxes are one of the biggest costs of wealth, and the wealthy know that the best way to protect money is to reduce what they lose to taxes. Tax-advantaged accounts are a key tool for this. These accounts allow money to grow without being taxed immediately, or sometimes not at all. The wealthy use these structures to maximize growth and protect wealth over the long term. The average person often views taxes as a fixed cost. The wealthy view taxes as a cost that can be managed. They plan around taxes because they know that even small differences in tax rates can have massive effects over time. This is not about cheating the system. It is about using the system intelligently. The wealthy understand the rules, and they use them to their advantage. They invest in accounts that provide growth, protect capital, and allow compounding to work without constant tax drag. This strategy becomes especially powerful over time. Compounding is the most powerful force in finance, and taxes can slow compounding significantly. The result is that the wealthy can build long-term wealth faster than someone who invests without tax planning. It is one of the main reasons why wealth compounds more quickly for those who understand the system. Use trusts for estate planning. The wealthy often use trusts as a way to protect wealth across generations. Trusts are not just a tool for inheritance, they are a way to manage how money is passed on, how it is protected, and how it is controlled over time. This is one of the most powerful tools in long-term wealth protection because it allows families to maintain control even after the original owner is gone. The key advantage of trusts is that they provide structure. They allow the wealthy to specify how assets are used, when they are distributed, and who benefits. This creates stability and protection across generations. It prevents money from being wasted, mismanaged, or lost due to lack of planning. Trusts also provide a level of privacy and control that is not available through simple inheritance. The wealthy use trusts to keep family wealth intact and to avoid the disruption of public legal processes. This ensures that wealth is preserved and passed on in a way that supports long-term goals. This is not just about avoiding complications, it is about protecting the future of a family. The wealthy understand that wealth is not just money, it is a legacy. Trusts allow them to preserve that legacy and ensure that it continues to grow. This is one of the reasons why wealth stays within certain families. It is not just because they earn more, it is because they have systems that protect and preserve wealth over time. Trusts are a key part of that system. Buy real estate in stable markets. Real estate is one of the most common tools the wealthy use to protect money because it is tangible, stable, and historically resilient. Real estate can provide income through rentals, appreciation through property value increases, and stability through long-term ownership. The wealthy often buy real estate in stable markets because it is a reliable way to preserve wealth. The key is choosing markets that are not just popular, but stable. Stability comes from consistent demand, strong local economies, and predictable growth. The wealthy look for these conditions because they reduce risk. Real estate is not just about buying property, it is about buying a system that generates long-term value. Real estate also acts as a hedge against inflation. When prices rise, property values tend to rise as well. Rent increases often follow inflation, which helps protect income. This is one of the reasons why real estate is a powerful tool in inflationary environments. It is a way to preserve value when cash is losing value. The wealthy also use real estate strategically. They buy properties that generate cash flow, that can be improved, or that can be held long-term. They treat real estate as a business, not just an investment. That approach allows them to build wealth consistently over time. The result is that real estate becomes a foundation of wealth protection. It is a tool that is both stable and powerful. And it is one of the main reasons why the wealthy can protect their money, while others struggle to keep up. Leverage insurance to protect wealth. Insurance is one of the most underestimated tools in wealth protection, and it is something the wealthy use constantly. The idea is simple. Rather than trying to avoid risk entirely, they transfer risk to a system designed to handle it. Insurance protects wealth by preventing one major event from wiping out years of progress. It is not just about car insurance or home insurance. The wealthy view insurance as a shield, not a cost. They understand that a single unexpected event can erase decades of wealth if it is not protected. Insurance provides peace of mind because it reduces the impact of life's uncertainties. This is especially important when wealth is tied to physical assets or businesses. Another important aspect is that the wealthy use different types of insurance in different ways. They use insurance to protect against risks that would otherwise require selling assets or taking on debt. They treat insurance as part of their financial planning, not just an afterthought. This is one of the reasons why they can maintain stability during crises. The average person often views insurance as a mandatory expense, but the wealthy see it as a strategic tool. They pay for protection because they understand the cost of not being protected. It is a long-term mindset. They are not just planning for tomorrow, they are planning for decades. Insurance also allows the wealthy to take calculated risks. Knowing that they are protected, they can pursue opportunities that would be too risky without coverage. This is a key difference in mindset. The wealthy do not avoid risk, they manage it. Ultimately, insurance is a key component of wealth protection because it helps preserve what has been built. It prevents sudden losses from becoming catastrophic, and it allows wealth to grow with greater stability. Use offshore accounts and entities. The wealthy often use offshore accounts and entities as part of their financial strategy, not because they are hiding money, but because they are managing risk, diversifying jurisdiction, and protecting assets. Offshore structures can provide flexibility, stability, and privacy in ways that are not always available domestically. The point is not secrecy, it is strategic financial planning. Offshore accounts can offer access to different banking systems, different currencies, and different investment opportunities. This allows the wealthy to diversify their financial base beyond a single country or system. It is a form of risk management that spreads exposure across different environments. If one system becomes unstable, they have other options. Another advantage is that offshore structures can provide protection from local economic volatility. When a country faces inflation, currency instability, or political uncertainty, having assets in other jurisdictions can provide stability. This is especially important for those who want to preserve wealth over time. The goal is to avoid being fully tied to the economic fate of one country. The wealthy also use offshore entities to structure investments in ways that are efficient and organized. This allows them to manage large portfolios, international investments, and business holdings with more flexibility. It is a system that supports complexity, which is often necessary for significant wealth. It is important to understand that offshore strategies are not just for the extremely wealthy, they are simply tools that require knowledge and planning. The wealthy have access to professional advisors who can set up these structures properly. The average person may not have the same access, but the concept is still valuable to understand. The key takeaway is that offshore accounts and entities are part of a broader strategy of diversification and protection. They allow the wealthy to reduce risk and maintain stability across different economic environments. Maintain a strong credit profile. A strong credit profile is one of the most powerful tools the wealthy use to protect and grow their wealth. Credit is not just about borrowing, it is about access. A strong credit profile gives people the ability to borrow at favorable rates, access opportunities quickly, and leverage financial tools that are not available to those with weak credit. The wealthy understand that credit is a resource that can be used strategically. The difference is that the wealthy use credit as a tool, not as a crutch. They borrow when it makes sense, and they use the borrowed money to generate more value. This could be through investments, business expansion, or property acquisition. The key is that they use credit in a way that increases their financial power rather than creating vulnerability. A strong credit profile also provides protection during tough times. When the economy shifts, having access to credit can provide a safety net. It allows the wealthy to maintain stability without selling assets at a loss. It is a way to stay flexible and adapt quickly. The average person often sees credit as something to avoid, but the wealthy see it as a strategic resource. They manage credit carefully, maintain low debt levels relative to income, and ensure they have access to favorable terms. This is one of the reasons they can move quickly and take advantage of opportunities. Credit is also a reflection of financial reputation. A strong credit profile signals reliability and stability, and that opens doors. The wealthy use this to access deals, investments, and opportunities that require trust and credibility. Ultimately, maintaining a strong credit profile is a key part of financial power. It is a tool that helps the wealthy protect their wealth, grow their assets, and maintain flexibility in an unpredictable world. Invest in blue-chip stocks and bonds. The wealthy often invest in blue-chip stocks and bonds because these assets provide stability and long-term growth. Blue-chip companies are established, profitable, and resilient. They may not be the fastest-growing companies, but they are reliable. Bonds provide income and stability. The wealthy use this combination to create a foundation of wealth that can withstand market cycles. The key advantage of blue-chip stocks is that they tend to perform well over long periods. They have strong business models, consistent revenue, and the ability to weather economic storms. This makes them a reliable part of a diversified portfolio. The wealthy often use blue-chip stocks as the core of their investments because they provide steady growth and stability. Bonds add a layer of protection. They provide income and reduce volatility. When markets are unstable, bonds can act as a buffer. The wealthy use bonds to balance risk and ensure that their portfolios do not collapse during downturns. This is not about avoiding risk entirely, it is about managing risk intelligently. The average investor often chases the next big stock or the latest trend, but the wealthy focus on long-term stability. They understand that building wealth is a marathon, not a sprint. Blue-chip stocks and bonds provide a reliable foundation that supports long-term growth without excessive risk. This strategy also supports compounding. The wealth that grows consistently over time becomes significant. The wealthy understand that consistency matters more than short-term excitement. They build portfolios that can grow through decades, not just years. Investing in blue-chip stocks and bonds is one of the core reasons why the wealthy can protect their money while others struggle. It is a strategy built on stability, reliability, and long-term thinking. Use professional financial advisors. One of the biggest advantages the wealthy have is access to professional financial advisors. This is not just about paying someone to manage money. It is about having a team that understands markets, strategies, tax planning, and risk management. The wealthy use advisors to build systems that protect and grow wealth. It is a level of expertise that is not accessible to everyone, and that is a major reason why wealth continues to grow. Financial advisors help the wealthy make decisions based on data and strategy rather than emotion. They create plans that account for long-term goals, market cycles, and potential risks. The wealthy do not rely on guesswork. They rely on expertise. This is one of the most important differences between ordinary investors and wealthy investors. Another advantage is that advisors can provide access to opportunities that are not available to the general public. They can connect clients to exclusive investments, specialized funds, and strategic partnerships. This access is a powerful tool because it opens doors that would otherwise be closed. Advisors also help maintain discipline. Wealth can be lost quickly through poor decisions made during emotional moments. Advisors help keep a long-term perspective and prevent impulsive actions. This is especially important during volatile periods when emotions can drive poor choices. Ultimately, professional financial advisors provide structure and strategy. They help the wealthy build systems that protect wealth across generations. This is one of the main reasons why the wealthy can maintain and grow their wealth consistently. The key takeaway is that the wealthy do not rely on luck. They rely on systems, expertise, and planning. And professional advisors are a major part of that system. Rebalance portfolios regularly. Rebalancing is one of those financial habits that sounds boring, but it is actually one of the most powerful tools the wealthy use to protect their money. Most people invest and then forget. The wealthy don't. They regularly review their portfolios and adjust the allocations based on performance and risk. The idea is simple. If one asset grows faster than others, it can become a larger portion of the portfolio than intended, increasing risk. Rebalancing brings the portfolio back to the intended balance, keeping risk under control and preventing the portfolio from becoming too concentrated. This is especially important during times of high volatility. Markets move fast, and the value of different assets can change quickly. Without rebalancing, a portfolio can become unintentionally risky. The wealthy treat rebalancing like maintenance. It is not exciting, but it is necessary. It is like checking the oil in a car. The wealthy also understand that rebalancing forces discipline. It creates a system where they sell assets that have become too high and buy assets that have become undervalued. This is the opposite of emotional investing, where people tend to buy high and sell low. Rebalancing ensures that decisions are made based on strategy rather than emotion. Another key point is that rebalancing helps protect gains. When an asset class performs well, rebalancing locks in some of those gains by reducing exposure to it. This prevents a portfolio from being overly dependent on a single asset's continued success. The average investor often ignores rebalancing because it requires attention and patience. The wealthy treat it as a core part of their financial system. They understand that a portfolio is not a set-it-and-forget-it asset. It is a living system that needs regular care. Ultimately, rebalancing is one of the reasons why the wealthy can protect their wealth through market cycles. It is a strategy that maintains stability, reduces risk, and keeps long-term goals on track. Use hedging strategies like options. Hedging is a strategy that the wealthy use to protect against downside risk. it is not about chasing the highest returns. It is about reducing the chance of large losses. Options are one of the most common tools for hedging. They allow investors to protect positions by locking in prices or limiting downside risk. This is a strategy that can be complex, but it is incredibly powerful when used correctly. The key advantage of hedging is that it allows investors to take risk without being fully exposed. The wealthy often use options to protect large positions. They can buy protection that limits losses while still allowing for upside. It is a way to stay in the market without being vulnerable to major downturns. Hedging is not just about protecting against losses, it is also about creating stability. When you know your downside is limited, you can make decisions with more confidence. This is one of the reasons why the wealthy can stay calm during market volatility. They have systems in place that reduce the emotional impact of market drops. The average investor often avoids options because they seem complicated. The wealthy, however, use them because they understand that complexity can be a tool. They use professional advisors and strategies to manage risk intelligently. Hedging is not a guarantee, but it is a protective layer that can reduce the impact of major market events. The truth is that markets can be unpredictable. The wealthy don't pretend they can predict the future. They plan for uncertainty. Hedging is a way to manage uncertainty without sacrificing growth. It is a strategy that helps protect wealth over the long term. Ultimately, hedging is one of the key reasons why the wealthy can protect their money while others get caught in market swings. It is a way to reduce risk and maintain stability in an unpredictable world. Keep wealth in long-term investments. Long-term investing is one of the most powerful strategies the wealthy use, and it is often overlooked by ordinary investors. The wealthy understand that wealth is built over time. They do not chase quick wins. They build systems that can grow steadily through decades. This is why long-term investments like index funds, blue-chip stocks, and stable real estate are common in wealthy portfolios. They provide consistent growth over time, even if the short-term market is volatile. The advantage of long-term investing is that it allows compounding to work. Compounding is one of the most powerful forces in finance, and it becomes more effective the longer money is invested. The wealthy understand this, and they use long-term investments to build wealth that grows exponentially over time. They don't try to beat the market. They let time work for them. Long-term investing also reduces the impact of emotional decisions. When investors focus on the long term, short-term volatility becomes less important. The wealthy can stay calm because they know that markets have cycles. They know that downturns are part of the process, not the end of it. This mindset prevents panic selling, which is one of the biggest mistakes ordinary investors make. Another key point is that long-term investments often have lower costs. Frequent trading can create high fees and tax consequences. The wealthy minimize these costs by maintaining long-term positions. This is a subtle but powerful advantage because costs can eat into returns over time. The result is that long-term investing creates stability and growth. It is a strategy that supports wealth preservation and wealth building at the same time. The wealthy use this approach because it is simple, effective, and reliable. Ultimately, long-term investing is one of the core reasons why the wealthy can protect their money. They focus on what works over time, not what looks exciting today. Avoid emotional financial decisions. Emotional decisions are one of the biggest threats to financial stability. The wealthy understand this better than most people. They know that fear and greed are powerful forces that can destroy wealth if they are allowed to drive decisions. That is why they build systems that remove emotion from investing. They rely on strategy, discipline, and planning. The average investor often buys when the market is high and sells when it is low. That is the natural human reaction. The wealthy do the opposite because they have systems that prevent emotional decisions. They have plans, advisors, and structures that keep them focused on long-term goals. Emotional decisions also create a cycle of regret. People make impulsive moves, see losses, and then become more fearful. That fear leads to more poor decisions. The wealthy avoid this cycle by staying disciplined. They do not let short-term market moves dictate their long-term strategy. The key is that the wealthy do not rely on luck. They rely on systems. They have plans that guide their actions. They know when to act and when to wait. This prevents them from being controlled by emotion. Understanding the importance of emotional control changes the way you view investing. It is not just about picking the right stocks, it is about maintaining the right mindset. The wealthy invest with patience and discipline, and that is why they can protect their money through market cycles. Ultimately, avoiding emotional financial decisions is one of the main reasons why the wealthy can stay stable while others get swept up in market swings. If this video helped you see how wealth protection really works, hit like and subscribe so you don't miss the next breakdown. Drop a comment with your thoughts, what strategy surprised you most, and what would you like to learn next? Stay aware, stay informed, and I'll see you in the next one.